Hello everybody and welcome back to another video on the finance channel. Today we will be looking at some important data that was recently released and it isn't looking that great. But even though it doesn't look that amazing, it will most likely lower inflation because the economy is slowing down. Now to start off, we will be looking at the manufacturing PMI. This basically tracks business activity in manufacturing. If this slows down, it usually leads to some form of a mild or, depending on how bad it gets, heavy recession. Which is not stellar, but something like that would lower inflation at least, so silver lining, I guess. Now, as you can see from the PMI numbers right here, it is below 50 at this point and currently sitting at below 48. Anything below 50 shows that the manufacturing in America is contracting, aka it's shrinking that part of the economy. As you can imagine, that's not good. And anytime there was a big recession, it went below 50. For example, here in 2020 and here in 2008-2009. Now, it isn't declining as sharply as we saw during those times, which was to be expected. So if it kind of goes on like this and doesn't become incredibly aggressive, then it's looking more like some sort of mild recession. But again, it depends on how low we go. Anything below 40 is a decent recession. Now, some of the reasons why they are running into these problems is because of higher costs due to inflation in both labor and materials, and also less interest from consumers to buy said goods due to them struggling with inflation, and now also higher interest rates, which is kind of limiting them in terms of taking on debt and managing credit and debt and stuff like that. Because the average interest rate goes higher on, for example, mortgages for homes, credit card loans, everything, you know? So due to that, we are seeing a slowdown. Now, there is some good news to be found in this report. I will be honest. Most manufacturers are very positive about next year. They do think there will be an uptick next year due to inflation also slowing down, which we can clearly see as well. And also the Fed becoming less aggressive. Aside from that, they are also experiencing lower costs for shipping, lumber, steel, all kinds of things. So the pressure on them is easing, which is good, which could save us from a major recession, you know? Like if pressure on them and the average consumer due to inflation going lower and interest rates not rising that fast or even coming down to an extent, then we could have a sort of soft landing. A bit of a rough landing, but at least no gigantic crash. But one thing they will keep struggling with is finding skilled laborers, finding work, people that want to work. And I have explained this in older eToro posts, so go check out my eToro account if you want to look into that. But the TLDR of it is my generation, the Gen Z and the millennials, aren't having as many children. Therefore, population growth is slowing down and has been slowing down for a very long time, actually. And we had a gigantic increase in population during the boomer era, the baby boomer era, which is around World War II and after. However, all those people from the baby boomer era are retiring. Around 10,000 baby boomers per day are retiring. And by 2030, all of them will be retired. And every time we get some sort of gigantic recession like this, we can see that the workforce participation rate actually goes down. As we can see from the data right here, every time there is it has been going down ever since 2000, but every time there is a recession, for example, here we had 2008, boom. Big contraction, never went back to those old levels. 2020, boom, back to 62, but we're most likely never going to see this level again. So the workforce is actually shrinking due to that. So personally, I think labor will remain a very tight market for a long time due to this effect. Maybe automation can help with it, but it's going to be a bit of an issue because those old people, they need to be taken care of. They spend fuck tons of money. However, sadly enough, there aren't as many people out there to take care of them and create the products that they consume. So the PMI is a bit bearish. sadly enough. However, if we look at consumer spending, we can see that consumer spending is slowing down. It is not as rapid as it was, but it's still going higher. So at least consumers are spending more. If this went down as well, then we would be in like a lot of trouble, actually. That combined with the PMI, oh my lord. So consumers are at least spending. And while consumer sentiment, as you can see right here, isn't amazing and is actually at one of the lowest points in history, which is usually not a good thing, it seems like it isn't going any lower. The lowest we hit was 50, which was during June, and currently we are sitting at 56.8. And as stated here above, along with the ongoing impact of inflation, consumers' attitudes have also been weighed down by rising borrowing costs, declining asset values, and weakening labor market expectations. All of this stuff gets better in time, which will give the consumer confidence again. This can be solved, depending on how inflation goes and what the central bank does. Now that was the big one we had to look at. The manufacturing PMI, consumer sentiment, and consumer spending. Those are very important. But now we're going to look at another sector of the economy, which is services. This one is also below 50 and contracting, which is quite sad because these people already had a very tough time during COVID because like a lot of restaurants and a lot of the service industry as a whole kind of shut down. But now they are also, again, running into problems, which I understand because places like restaurants have a hard time getting employees, food prices are rising, gas prices are rising, so that's putting a lot of pressure on, for example, restaurants. So I understand why they are in trouble. But again, the message here is kind of the same. And so long as inflation comes down and the Federal Reserve kind of calms down or even lowers interest rates a little bit as inflation comes down and cools down as well, we could actually avoid a very big problem here. However, if inflation keeps rising or remains high and the Federal Reserve is forced to become even more aggressive or maintain its current very aggressive stance, then we are in for a lot of trouble because we can see the cracks forming in the economy itself. Demand is going down and services and manufacturing, which are huge parts of the economy, are contracting instead of growing. I mean, we are in luck that the GDP in the third quarter of this year was positive by 2.6% because before that we were actually looking at a contraction, as you can see, by 1.6 and 0.6. So far we're kind of running neutral this year in terms of GDP growth, but there is a decent chance with these numbers of the manufacturing and services PMI coming in that we will see a negative fourth quarter for this year. So stuff is a bit mixed, as you can see. So personally, I will keep an eye on all of this, especially what happens to inflation and the Federal Reserve at this point. In more recent data, we have actually seen the recent Fed minutes, which actually came out yesterday, if I remember correctly, the 23rd of November. Federal Reserve is clearly showing that they are going to slow down with the interest rate hikes and will become less aggressive, which is understandable because their target of lowering inflation is being reached. As I have pointed out in older videos, showing off, for example, the M2 money supply, aka the money's in people's pockets and banks going down, aka people have less money to spend in the economy, and inflation is a monetary phenomena as well as a psychological one. And we can also see that there is a good slowdown in the economy at this point. So if they become any more aggressive at this point, it would end in disaster. So it's good to see that they are slowing down their entire crusade, to put it that way. So personally, I will keep an eye on what their next plan is, what they are going to do, and we'll most likely get this information in December. And aside from that, I will obviously keep an eye on the whole PMI, services and manufacturing and consumer spending to see if the economy is actually going to retract aggressively or just a mild recession, you know? Because if it's a mild recession, that has already been kind of priced in. Because one thing you got to remember always with the economy, when the economy finally goes into a recession, the stock market has already bottomed. This always happens. And that's because the job of people on Wall Street and investors is to predict the future. So usually the market is one step ahead of the actual economy. We saw the same thing in 2008 when the actual consumer got hit and the entire housing crisis, the entire economy tumbled down in 2008, 2009. The market had already bottomed and was going back up again. This could actually be the bottom for the market if this becomes a mild recession. If this becomes worse than a mild recession, then we are most likely in for more pain. Thank you all so much for watching. I hope you enjoyed this video. I hope you found this information useful. If you want to know any stuff or have any questions or want sources, whatever, just ask in the comments down below and I will supply it. And be sure to subscribe and click the bell button and join the channel. And I will supply you with more amazing updates on the economy and long-term investing in general.